International Seaways, ticker INSW,
Yeah.
they just reported a quarter that completely breaks the scale of what we normally expect from shipping stocks. They absolutely obliterated Q2 consensus.
Oh, yeah.
Revenue hit $467.29 million, which just crushed the $401.77 million estimate. Earnings per share came in at $5.91, again, comfortably beating the $5.52 consensus. And looking ahead, their Q3 guidance shows spot TCE booked at approximately $61,000 per day.
Right.
Yet despite dropping what can only really be described as a financial bombshell, the stock barely yawned. It moved up roughly 2% to trade around $97.05.
Which really defines our mission for you today. Because
Yeah.
if you are a retail investor and you're staring at these numbers, the immediate question is, why is the market essentially shrugging off a literal cash printing machine?
Exactly.
So we are going to unpack this entire stack of earnings transcripts, the financial filings, analyst notes, all of it, to figure out exactly how International Seaways achieved this record-breaking quarter. We need to see where these, frankly, unprecedented margins are actually coming from.
Yeah, and whether this tanker boom is like a durable multi-year trend or just a cyclical peak right before a cliff.
Right.
So let's start with the sheer scale of the cash being generated here, because doing the live math on these margins is it's staggering.
It really is.
They reported a record-adjusted net income of $295 million and an adjusted EBITDA of $345 million. But the metric that really just stops you in your tracks is the free cash flow.
Oh, absolutely.
They generated $261 million in pure free cash flow in 3 months. That is $100 million higher than their next closest quarter in company history.
Which is wild.
Right. If you annualize that, you're talking about like $1 billion in free cash flow on a company with a market cap hovering around just $4.8 billion.
Yeah, and the engine driving those figures is the sheer explosion in their blended spot TCE rates.
Yeah.
And just a quick reminder, TCE stands for time charter equivalent. It's basically the standard industry metric for calculating daily vessel earnings. So in the second quarter, their fleet averaged $79,000 a day. Now, for some context on how dramatically the market has shifted, just look at the exact same quarter last year.
Right.
They were averaging $27,500 a day. So rates essentially tripled year over year. And they even jumped significantly from the $55,600 they saw in just the first quarter of this year.
Wait, if spot rates are $79,000, we really need to talk about the cost side of the equation to understand that free cash flow.
Okay.
Because digging into the filings, their fleet-wide spot cash break-even rate, which is, the amount it costs to actually run the ships, pay the crew, cover insurance, service the debt, it's still sitting below $14,500 a day for the next year.
Yeah.
It's like running a global taxi fleet where your daily operating cost is fixed at $14.50, but suddenly customers are forced to pay $79 for the exact same ride.
That's a great way to put it.
That $64,000 gap per ship per day is pure margin. And you multiply that across dozens of vessels over 90 days, and the cash flow numbers start to look completely absurd.
Well, that operational leverage is really the defining characteristic of the shipping industry. I mean, once your fixed costs are covered at that $14,500 mark, every single additional dollar of revenue flows straight to the bottom line.
Straight to cash.
Exactly. But it is important to note that this wasn't just a generic rising tide lifting all vessels equally. Specific asset classes within their fleet just vastly outperform.
Right, the VLCCs.
Yes, the very large crude carriers, which are basically the absolute leviathans of the ocean. They were the primary engines of this beat. Management actually highlighted that they have 3 fixed VLCC vessels operating under these specific profit-sharing arrangements.
Okay, those profit-sharing agreements are fascinating to me. They aren't just locking in a flat daily rate and watching the spot market sail past them, right?
Okay.
How exactly does that mechanism work to push their blended VLCC earnings to over $150,000 a day?
So it functions as a structured hedge with an open ceiling. Instead of chartering the vessel out at a flat, say $40,000 a day for a year, they agree to a lower base rate.
Okay.
And that lower base rate guarantees their operating costs are covered, essentially ensuring the ship never loses money. But in exchange for that lower base rate, they negotiate a split of any profits generated above a certain benchmark in the open spot market.
Ah, I see.
Yeah, so because the spot market went entirely parabolic, that profit-sharing clause kicked in aggressively. It allows them to maintain this rigid floor under their earnings while keeping their exposure to the upside volatility completely blown off.
Wow. And it wasn't just the massive crude carriers doing the heavy lifting either. CEO Lois Zabrecki spent a lot of time on the earnings call pointing to their LR1 vessels as these unexpected stars this quarter.
Right, the LR1s.
Yeah, the long-range one-product tankers. They are mid-sized vessels that typically carry refined products like gasoline or diesel rather than unrefined crude oil. Zabrocki noted they stepped into this vacuum in the Americas niche trade, but she didn't really elaborate deeply on the physical logistics of that. Why are these mid-sized product tankers suddenly commanding ransom-level rates in the Americas?
Well, it's because the physical reality of the global shipping map right now is heavily distorted.
How so?
Because the largest product tankers in the global fleet are currently being pulled into these sprawling cross-hemisphere routes due to market dislocations. And we will definitely touch on those in a second. But that has completely drained vessel supply in localized regions.
Okay, that makes sense.
Right. So the Americas, specifically the U.S. Gulf Coast, exports an immense volume of refined petroleum products. Usually larger vessels handle a chunk of this, but with those bigger ships tied up on the exact opposite side of the planet, regional routes in the Americas were left completely devoid of available tonnage.
So the LR1s just stepped right in.
Exactly. The LR1s, which are, the perfect size to navigate the draft restrictions of certain regional ports in the Panama Canal, they swooped right into that supply vacuum.
Wow.
I mean, when charterers have millions of barrels of diesel sitting in Texas that absolutely must get to South America, and you hold the only available ships, you dictate the price.
You definitely do. And that structural pricing power leads directly into the geopolitical side of this story. Because, why are those larger ships tied up on the other side of the planet in the first place?
Right.
When you look at management's commentary, they point squarely at the conflicts in the Strait of Hormuz and Bab el-Mandeb.
Yeah, those two choke points are currently experiencing one of the most severe maritime security disruptions in modern history. The sheer volume at stake there is, well, it's hard to overstate.
It's massive.
Historically, nearly 25 million barrels per day of crude and petroleum products pass through those specific corridors. Because of the ongoing security risks, major charterers and vessel owners are just refusing to transit the Red Sea and the Suez Canal.
They're going all the way around.
Right. They are actively rerouting cargoes down and around the Cape of Good Hope at the southern tip of Africa.
Which introduces the concept of ton-mile demand.
Yeah.
For anyone listening who's looking at the oil markets and wondering why tanker rates are sky high when global oil consumption hasn't dramatically spiked, ton-mile demand is the missing puzzle piece here.
Exactly.
It's not just a measure of how much oil the world is burning. It's a calculation of volume multiplied by the distance it has to travel on the water. If you take a voyage from the Middle East to Europe that historically took 20 days through the Suez Canal, and you force that ship to sail around Africa, that voyage suddenly takes 40 days.
Yep.
You have effectively cut the available supply of that specific vessel in half, because it can only complete half as many voyages in a year.
You are artificially tightening the global vessel supply without a single ship being sent to the scrapyard. That extended transit time absorbs a tremendous amount of tonnage. And that artificially tight supply is crashing headfirst into a demand environment that management describes as remarkably resilient.
Right.
However, there's a critical nuance hidden in the earnings call regarding why commercial oil inventories appear so stable right now despite these extended transit times. Management pointed out that government strategic petroleum reserves, the SPRs, have been quietly doing the heavy lifting. Yeah, governments have been releasing barrels from their strategic reserves into the market to basically mask these supply chain disruptions and keep local commercial inventories from draining.
Wait, but if SPRs are actively draining just to keep commercial inventories looking stable, isn't that just a temporary Band-Aid? Like, what happens to global consumption when governments hit their absolute reserve limits and just can't prop up the supply anymore?
Well, that is the exact tension the broader energy market is grappling with right now. If these geopolitical disruptions persist for a multi-year period and strategic reserves reach critically low levels where governments flat out refuse to release more, the risk shifts entirely to global consumption.
Because prices go up.
Right. The actual cost of crude and refined products would likely spike, which historically weighs heavily on the broader economy and depresses overall oil demand. And if global oil demand drops, the requirement to move that oil drops, which would severely impact the tanker market.
So the SPR drain is acting as a global shock absorber right now.
Exactly. But mechanical shock absorbers eventually bottomed out.
Yeah, they do. But okay, setting aside the macro fears for a moment, the reality is that the shock absorbers haven't bottomed out yet. And International Seaways just banked $261 million in free cash flow.
They did.
So if you are a retail investor holding this stock, the most critical question is what management is actually doing with that mountain of cash. Because in cyclical industries like shipping, piles of cash often lead to terrible decisions. Companies tend to overbuild, they flood the market with new ships, and they crash their own rates. Are they making that mistake here? Let's look at shareholder returns first.
So they're currently avoiding that classic shipping pitfall by basically shoveling a vast majority of that cash directly into investors' pockets.
Nice.
They declared a quarterly dividend of $5.05 per share, and that payout aligns with their stated very strict commitment to return at least 85% of adjusted net income to shareholders.
85%.
Yeah, to put a hard number on that strategy, they have returned $500 million to shareholders in just the first 6 months of 2026.
$500 million.
Right. For a mid-cap company, returning $500 million in 2 quarters is an extraordinarily aggressive capital allocation strategy. They are not hoarding cash to build an empire, They are distributing the windfall.
But they aren't entirely ignoring the fleet either. They did announce reinvestment. The transcript details an order for 4 additional LR1 new buildings scheduled for delivery in the second half of 2028. The aggregate price for these 4 ships is $244 million. Now, buying ships at the top of the market is usually a huge red flag, but the specific detail that jumps off the page is the pricing.
Oh, the pricing is incredible.
Yeah, they managed to secure these new buildings at essentially the exact same price they paid for similar vessels 3 years ago in 2023.
Securing yard slots at that price point is a major competitive coup. I mean, the shipbuilding industry, which is largely concentrated in South Korea and China, has experienced severe double-digit inflation over the last 3 years.
Right, everything is more expensive.
Exactly. Furthermore, those shipyards are currently booked solid. The post-COVID boom in container shipping and the ongoing demand for specialized LNG carriers have taken up virtually all the prime construction slots. Merely getting a slot for 2028 at a high-quality Korean shipyard is difficult. Securing it without paying the massive inflationary premium, that is a strategic win.
Definitely.
By the time these 4 ships deliver, they will form a cohesive 10-vessel series, giving the company modern tonnage ready to seamlessly replace older ships as they just age out of the commercial fleet.
And they are executing this fleet renewal while sitting on what looks like an impenetrable balance sheet. I mean, they reported $935 million in total liquidity, which includes over $400 million in raw cash. Looking at their debt profile, the gross debt is around $651 million. But when you net out the cash, their net debt is roughly $250 million.
And to understand the strength of that position, you really have to look at the loan-to-value ratio. When you compare that $250 million in net debt to a fleet valued by the market at nearly $4 billion, you arrive at a net loan-to-value ratio of approximately 6%. 6%. So if this were a typical $500,000 house, their mortgage would be just $30,000. They basically own this multi-billion-dollar global fleet free and clear.
That is the perfect way to contextualize it. They have 25 unencumbered vessels, entirely ships with absolutely zero debt tied to them. In the historical context of the shipping sector, which is, notorious for companies running at 60% or 70% leverage and going bankrupt the moment rates drop, a 6% net LTV provides incredible financial elasticity. They are fully insulated from the downside of the cycle.
Speaking of elasticity, they're also making some structural commercial moves. The filings mentioned they are consolidating control within the Tankers International, or TI, Suezmax pool. Now, for listeners who aren't deep in the weeds of maritime logistics, what exactly is a commercial shipping pool, and why does controlling one give them an edge? Right, so a commercial shipping pool operates somewhat like a legal syndicate for ship owners. Instead of 20 different companies each trying to market their 1 or 2 Suezmax vessels independently to oil majors like Exxon or Shell, they pool those vessels together into a single, centrally managed commercial fleet.
Okay.
The pool operators negotiate the contracts, they schedule the voyages, and then they distribute the revenue back to the owners based on a point system tied to each ship's performance and efficiency.
So it prevents a race to the bottom where independent owners just undercut each other on price to keep their ships moving.
Precisely. By consolidating control over a majority of the vessels within this specific TI pool, International Seaways gains immense leverage. They possess better data on global cargo movements. They can offer major charterers a flexible, reliable fleet rather than just a single ship. And they essentially extract a higher average rate by optimizing the logistics and reducing the number of days ships sit idle waiting for cargo.
Okay, let's step back and look at the whole board for a second. The balance sheet is essentially bulletproof with a 6% net LTV. The dividend is paying out $500 million every 6 months.
Yep.
The commercial strategy is squeezing charterers for higher rates, and the cash flow is breaking company records at $261 million a quarter. If you are listening to this and wondering why a company with these metrics is trading at a ridiculously low PE ratio of roughly 6 to 8, you have to look at the historical graveyard of shipping cycles. Why is the broader market effectively ignoring this earnings beat?
Well, the market's deep-rooted skepticism really stems from the fact that the stock is currently trading near its 52-week high. When a highly cyclical shipping stock trades at a single-digit PE ratio, it is rarely a signal that the stock is cheap.
Right.
Instead, it usually signals that the broader market believes earnings have mathematically peaked. Institutional investors look at that $79,000 a day spot rate, they look at historical averages, and they assume it is physically impossible to sustain those levels over a multi-year horizon. They have already priced in the current boom.
Which brings us directly to the immediate, tangible risks threatening to pop this bubble. The biggest and most obvious threat is the geopolitical premium.
Absolutely.
If diplomatic efforts succeed, tensions in the Middle East ease, and the Red Sea reopens to normal, safe commercial traffic, that entire rerouting tailwind evaporates overnight.
Poof, gone.
The ships go back to using the Suez Canal, voyages drop from 40 days back to 20 days, ton-mile demand collapses, and vessel supply suddenly floods the market. If that happens, those spot rates will plummet.
And we're actually already seeing early indicators of spot market volatility softening the outlook. Management guided that for the third quarter, they're currently only 48% booked, and those forward bookings are sitting at a blended spot TCE of $61,000 a day.
Okay.
Now, to be clear, $61,000 is still vastly above their $14,500 break-in, meaning they will continue to generate substantial free cash flow. But leaving over 50% of your available revenue days exposed to the open spot market in a quarter known for seasonal volatility, that means their earnings visibility for the rest of the year is inherently murky.
And beyond the immediate quarter, they face systemic, long-term industry risks, too. I mean, even with a great deal on those 4 new LR1s, fleet renewal costs are skyrocketing across the board.
Very true.
Furthermore, any tanker company faces the overarching existential threat of a potential long-term decline in global fossil fuel demand as the energy transition accelerates. Add in the rapidly rising costs of environmental compliance. I mean, new regulations are forcing older, less efficient ships to literally sail at slower speeds to reduce emissions, and the overhead gets heavy.
Yeah, it does.
So this sets up the defining debate for the retail investor. Is the market looking a gift horse in the mouth by slapping a 6 PE on a company with no debt and massive cash flow? Or are investors walking directly into a classic value trap at the absolute peak of a shipping cycle?
Well, the value trap argument relies on the historical precedent that peak earnings never last. And buying shipping stocks at the top of the white cycle just leaves you holding a depreciating asset when rates inevitably normalize. The gift horse argument, however, relies entirely on that 6% loan-to-value ratio. Unlike previous cycles in, 2008 or 2015, where shipping companies were swimming in leverage and went bankrupt when rates fell, International Seaways has insulated itself. Even if spot rates crash by 50% tomorrow, they remain highly profitable.
That's a huge distinction.
It is. Additionally, the supply side of the global fleet is aging rapidly. By 2030, over 50% of the world's tanker fleet is expected to be over 20 years old, making them prime candidates for the scrapyard. No one is building new crude tankers fast enough to replace them. That structural supply constraint could keep a hard floor under daily rates, even if the geopolitical tensions ease entirely.
It really highlights the tug-of-war between short-term spot market volatility and long-term structural supply shortages.
It does. And there is one final macroeconomic variable to consider that builds on our earlier discussion about strategic petroleum reserves.
Oh.
We noted that governments have heavily drawn down their SPRs to mask the current supply disruptions. Let's assume the bear case plays out. The geopolitical tensions resolve, the choke points open up, the rerouting ends, and tanker rates begin to normalize downward. Eventually, those